Hi everyone, welcome back to Seven Figures. In today's episode, I'm going to be keeping it very short. It's just an update on the portfolio. Didn't want to go too long without making a video. It's been 2 weeks, and the portfolio is now at $31,500 total. And we're going to go over the dividend portfolio, the growth portfolio, and the Boglehead portfolio. Show you show you guys how it's all doing and where we're tracking 11 and a half months in. I'll be doing another episode probably in 2 weeks to show a 1 year look back on the performance of this portfolio and this experiment, as well as giving you some background on dividend investing and some of the dangers that people can overlook when they're looking to invest specifically just in dividends. With that said, let's go ahead and take a look at the dividend portfolio first. Now here we are in the dividend income portfolio. Things have improved greatly since the last 2 weeks. I think the last episode I made, this portfolio was still down in the double digits. Now it's only down 6.89% or around $425. As you can see down here on earned dividends, the goal of this portfolio, it's earned around $245 in dividends, but the market gains haven't been so kind. It's down $670. So over time, this portfolio has been up as much as 13, 14%, but it's so heavily skewed to consumer goods that it gets harmed really badly when the economy is doing poorly. So let's go down here and look at the list of the different sectors that are in this portfolio. And first, let's see which sectors have actually been major gainers. No surprise there in the current environment we're in. With the pandemic, healthcare is up 23.5%. Technology is up 21.5%. We're all working from home. Bonds are up 17.55%. Safety, everyone's looking for income or yield. And alternatives are barely up 0.5%. So not a lot of sectors are doing well, but the ones that you'd expect to do well in pandemic are all doing really excellent. Now let's look at the laggards. And like this about M1 Finance quickly shows me where my laggards are. Energy, no question about that. At one point, oil was negative. You could actually get paid to take oil. Down 33%. Financials, 28%. I'm a big believer in these, but financials are beaten down because there's a risk people are not paying their bills. Consumer discretionaries, like it says in the name, discretionary. You spend it because you want to. These are all down. REITs, was worried about these from the very beginning, but obviously with evictions expected to go up, REITs are going to take a beating. And then industrials, they're all linked back to stuff that people buy all the time. And there's a risk that we're not going to be buying very much when we're all losing our jobs or likely to have reduced pay. A little confounding here for utilities to be down because you're still going to pay them, but I think utilities were overpriced to begin with. Everyone was looking for yield, especially dividend investors. We're kind of overpaying for that. And again, confounding for me is communications because I'm obviously on the internet right now. I'm not cutting a lot of my Wi-Fi stuff or telephone or even Netflix, which is part of communications. And then consumer staples, that one's also confounding because that's made up of a lot of things that we need, food, etc. So that's really it for the dividend portfolio. I'm going to go ahead and move over to the growth portfolio, as I said. Now here we are in the growth portfolio. As you can see, this one's just been a rocket ship, literally, like a rocket ship. And also one of the big companies on here is run by a guy who actually has a rocket company. Up 120%. At one point this week, this portfolio is up 130%. It's pulled back a little bit, and you'll see down below, it's up close to $7,000 on net cash flows of $8,000 that I put in here. So it's done really, really well. As you can look at the pie chart, there are two companies that stick out like a sore thumb, and I'm going to go through them in a second. Looking at the over time graph here, you can see that we're at the peak, but the peak was actually a few days ago. But this portfolio has just been moving straight up. Went down pretty hard during the crisis and has recovered really nicely because of all the companies that are in here being so dominant in their spaces. So similar to the dividend portfolio, I'll go ahead and look at there's only 11 stocks in here. Let's start with the big gainers. No surprise there. Tesla at the very top. It's up 666%, 661%. It was up almost 700% a few days ago. Invitae is up 189%. And then AMD is up 87%. Amazon is up 74%. Those are like the big gainers. Looking at the laggards, there's really just one that's in the negative, and that's Uber. And I've been actually putting money into Uber the last few days. So no questions about Uber. I think I'll be putting more money in there. Beyond Meat up 17%. Alphabet or Google up 34%. Not going to complain about that. Facebook up 37 or 38%, and Alibaba up 52%. I mean, this portfolio, there really isn't an issue with it. There's no laggards. Most of the companies in here are just really dominant. And there's one keyword I always use when I'm going over this portfolio, and that's monopolistic. These companies are all monopolistic in nature. So they're going to keep dominating their space. They're going to probably take over it. And that's why they're not being harmed by the market downturn. Let's move on to the Boglehead portfolio. So here we are on the Boglehead portfolio. And this is one of my favorite portfolios just because it's the one I recommend to a lot of people. You're going to see in a second. Up 10.77% or $662 on cash flows of $8,192. It's important to note that this $892 you see here, that's cash flow, net cash flow, includes the dividends earned, which is $159. Now, if you remember, or if you take a look at the dividend portfolio, it's only paid out $250 or $245 in dividends. This one's paid out $159 or $160 in dividends. So if you're someone who actually wants to be a dividend investor, this is one of the paths you can actually take where you don't have to worry about picking specific stocks, and you can just do a 50-50 index fund type of investment, and then let the portfolio take care of itself. But it's up nicely, 10.7%. As you can see here on the pie chart on the left, nothing special. It's kind of split in the middle. And if you look at the over time portfolio, in terms of the graph, you can see that this is just as steady as she goes. No spikes, not huge drops. It's just pretty steady. Hard to really panic when you have a portfolio like this because you're basically barbelling it. If one side does well, the other side could be doing poorly, and they'll balance it out, and vice versa. So when we go down here, we look at the Total World Index Fund, and that's up 10.9%. So the equity side is doing pretty well. And now it's exactly at actual 50.7%. The target is 50%. So it's barely above that because it's done a little bit better than the bonds. The Vanguard Total Bond Market Index Fund is up 10.66%. So don't let anybody fool you and tell you that you can't make money in bonds. Bonds are actually a very good place to make money in good or bad times for the most part. The biggest part of the market is actually the bond market. The equity market is actually tiny compared to the debt market. So a lot of the big investors, especially the hedge funds that do really well, invest heavily in the debt market, but in a very different way from most retail investors like us. So that's really it for the Boglehead portfolio or the balanced portfolio. This is one of my favorite ones, the one that I recommend to pretty much anybody that is starting out. This is it for today's video. If you like the concept and the content, please subscribe. And if possible, hit the thumbs up so others can actually find the content. Thanks and have a good day.